One of ING Investment Management's flagship strategies is the high dividend strategy. Here to tell us more is Ghielen. Carl, welcome.
Thank you.
Equity markets exhibited a strong last quarter. Could you tell us more about that? Did the high dividend strategies exhibit strong performance as well?
Indeed, global equities had a strong but volatile quarter. MSCI World rose 5.5% in euro terms, bringing the total year return almost 20%. So for euro investors, a very strong year, led by economic activity that improved. Also earnings momentum turned positive, and also the monetary policies from central banks were supportive. This was partly offset by the increased risk aversion from investors and also the steep decline in oil price. The high dividend funds had a difficult quarter because there's a lot of headwinds from a style perspective. So investors clearly preferred growth compared to the value style.
What about style trends over the last quarter?
Yeah, besides the already mentioned preference for growth versus value, investors also preferred small caps in Q4 as the economic activity improved. For the year as a whole, 2014, we saw that large caps clearly outperformed, but also the low risk names in the market. From a regional perspective, we saw that the US clearly outperformed the rest of the regions because of the strong economic momentum. And we saw that the Global High Dividend Fund was hurt by this because they have an underweight in the in the US region and an overweight in the European region.
What were the most significant changes you made to the portfolio in the last quarter?
That depends a bit on strategy, but for the euro and also for the global fund, we added some names to the consumer discretionary sector because this sector clearly gains from the lowered oil price, so the consumers can spend a bit more. For the euro fund, we also added a bit to the healthcare sector as there were some interesting valuation opportunities. And in addition, we took some profit in the consumer staples sector with Nutreco, who was one of the names that were taken over. Furthermore, for the US High Dividend Fund, we did some stock-specific trades. We took some profit in few winners, and we added to some of the laggards. In general, no significant sector changes. Also for the global fund, we took some profit in the energy sector by reducing some of the oil sensitivity names, like the E&P companies in the portfolio. Finally, for emerging markets, also some trades on a stock-specific level, resulting in the underweight in Asia, especially the IT sector, and an overweight in Central and Eastern Europe.
Regarding positioning, can you tell us a bit more?
What we do have in the portfolios is a clear preference for cyclicals, especially with strong balance sheets and also positive earnings momentum. We have some overweights in the industrial sector like transport, but also IT. And we have a preference for financials over healthcare and consumer staples and consumer discretionary, because financials clearly can benefit from economic recovery. They also have an improved credit conditions, strong balance sheets, and attractive valuation as well. Finally, some of the healthcare and consumer staples names are really expensive, fully valued, and they are sensitive to some increased bond yields in the future.
I've also heard that you recently celebrated an anniversary. Congratulations. Can you tell us a bit more about that?
Indeed. Last April, we celebrated the 15-year anniversary of the Euro High Dividend Fund. And last December, we celebrated the 10-year anniversary of the Europe High Dividend Fund. So this clearly shows the long and strong experience we have in dividend investing. And moreover, we have the portfolio managers managing the funds since inception. So Nicola for 15 years and Manu for 10 years. So I think that's a pretty good achievement in this industry.
That is pretty exceptional. Thank you so much for joining us, Carl.
Thank you.